Hello and welcome to CMXtra, the Capital Markets Exchange podcast. Yes, we are back after a ludicrously successful in-person event in London back in June. We're back on the podcast with more capital markets conversations, insights, and later on some intel on the next in-person CMX event. So stay tuned. On the podcast over the next few months, we're going to be engaging in conversation with more experts from throughout the community on a diverse range of topics. And we're lining up some really, really interesting stuff. But if there is something you'd like us to cover or somebody you'd like us to speak to, then, well, do let us know. Today, we're welcoming back two guests from the in-person CMX event before the summer to share their vast insights and experience on dealer wallet share and getting the most from sell-side partners. And the context here is what some would see as the proliferation of new counterparties offering liquidity in the market and different types of counterparties offering different opportunities versus, for example, tier one banks, agency brokers, and so on. Meanwhile, cost pressures on the buy side are, at least in some shops, reducing the size and makeup of dealer panels across different asset classes. Well, here to share the wealth of their experiences and offer up some practical advice, whichever side of the desk you sit, please welcome senior fixed income trader at Abrdn, Eohan O'Reilly. Hello, Eohan. Good to see you again.
Hi there. Good to be back. Thanks.
And former sell-side director of market structure at one of the major sell-side firms and cross-asset market structure and e-trading expert, as well as co-chair of FIX EMEA, Matt Coupe. Hello, Matt.
Hey, David. Thanks for having me.
Matt, that's a long job title. In a nutshell, you've been around for a while and you've got fingers in lots of pies. Is that the summary?
I'd add market structure geek to the title as well.
Okay, yeah, we're very happy to have geeks and nerds in job titles here on the show. Thank you both for joining us today. So as we touched on in the setup there a moment ago, there certainly is pressure on the buy side to reduce their counterparty panels. Eohan, I'll come to you first of all on this. What are some of the reasons behind this and what practically does it mean? What kind of challenges does that present you with?
Well, there is fee compression in the industry generally, which has led to cost cutting in Abrdn and in our peers. Broker panels in themselves isn't a huge cost center, but there is significant amount of resources needed in terms of regulatory oversight and just setting up and maintaining lines. So the trajectory is definitely to reduce, not increase the panels. Now, we also have to bear in mind our ability to service our clients. So we don't want that liquidity we provide to our clients to decrease as a result of that. So we do use other means to provide liquidity, such as platforms. If we remove lines from a counterparty, we still have the option, usually have the option to trade with them, but via an e-platform such as Market Access or TradeWeb, which in theory doesn't decrease our ability to provide liquidity.
Yeah, we'll certainly be coming on to platforms later on today. Matt, from your side, are there any similar pressures that the sell side is facing at the moment in terms of how things are changing, how things are evolving in this area?
Yeah, definitely. And I'd agree with Owen's comments. When you look at the sell side, there are cost constraints and pressures, costs of income. Questions are continually asked across the sell side environment. And so, you've got to look at the maintenance and the regulatory costs for onboarding and continue to maintain. Even if you're doing it through platform, you are onboarding the client, that client as a counterparty. It might be more riskless if it's going through a clearinghouse, if you're talking about OTC derivatives, but there is still an onboarding requirement in the fixed income world with a direct counterparty, and there are high costs to that in terms of the AML and KYC. So when you're onboarding that relationship with that cost also, we are in a financial markets environment. We need to make profits from that as well. So that is a consideration, I think, on both sides.
And Eohan, how are panels changing then? We're talking about a changing context, changing market, changing environment in which you guys are operating. How are your panels changing? Maybe we set it up earlier, different types of liquidity providers, and what does that ultimately mean for wallet share?
Well, I suppose the new entrants would be the algorithmic traders, such as Jane Street and Flow traders. Typically, they're e-trading only. That's become an increasingly larger slice of our business. There's numerous reasons for that. I'd say regulation is kind of pushing us in that direction generally. So they often see our flow, and even if they don't win our flow on those platforms, they do provide valuable information, and they're very quick to price. So for me, they're a kind of a valuable addition to our panels.
Yeah, I think I agree with that. I mean, if you look at the growth of what you've seen in terms of the proprietary trading firms and then the liquidity they're providing to the market, you've seen huge growth across a number of the product types. I think critically, there's a lot of value in the liquidity that they provide. But critically, there's a conceived consideration, as Eoghan said, is a lot of this is electronic only. Now, I also understand that these guys are also providing OTC liquidity, but critically, they do not have the same balance sheets as traditional banks. So when you're trying to shift significant risk, that there needs to be a consideration in terms of what's coming. It's not to say that they can't, because if you look at the size of some portfolio trades that go through in credit, they are huge in notional value, but not necessarily in terms of risk that's being done in terms of the whole portfolio. But there's a consideration there that needs to be looked at. But critically, Eoghan always has best X at the back of his mind in terms of how he's thinking about this on a trade, but also on an aggregate level.
Yeah, that's true. And so we wouldn't be showing them kind of large risk transfer trades. We would do the banks, but certainly on the smaller platform trades, they are very competitive.
I know in the space in which you operate, correct me if I'm wrong here, but particularly in emerging markets, are you finding that landscape changing as well in terms of the variety and the number of maybe mainstream, but also some more of the niche players there that you might want to engage with?
Yeah, we absolutely need to keep our doors open to these guys because of the nature of what we're trading. So some markets aren't as well covered by the banks, and in which case there is that local specialized knowledge from the regional players, say, that we need to be able to tap into. So we can't just stick to trading with the top tier bulge bracket banks. We need to be able to have lines with these guys and receive color and kind of relevant access from them, which is valuable to our clients.
Yeah. I mean, I completely agree with that, because when you look at it, it goes back to variety and the different products that you're trading. There's a lot of time where you can get standard coverage from the banks, but there's times when you need, if you're trading local currency, you need to have that local environment where you're not going to be putting a huge amount of flow, but you need to be able to access that liquidity. And it's critical to be able to have that panel.
That's true, yeah. And particularly in frontier markets, most of the onshore liquidity comes from pension funds, and the agency brokers in those markets tend to have maybe worked for the pension funds or at least have a good relationship with them. So that's kind of vital to be able to move risk in those markets, to have that source of liquidity.
Does that therefore mean, I mean, I don't know how many different providers that you have on your panel, but does that mean that if you are operating in those markets and you do need to look to those niche players for particular value, does that mean that you would necessarily need to have a longer panel, a larger panel, in order to satiate all of those different needs? And does that present you with a different challenge then?
Not necessarily. I think there's enough room usually on our panel for both. It kind of just tends to grow organically. So you kind of need to be a bit careful about adding brokers, infinitely. Typically at the moment, I think we probably have about 50 lines in place for fixed income. We don't that could probably be reduced. And typically if we want to open a new line, we'll need to close an existing one.
Right, no room at the inn. Matt, is that common from your view on the other side as well, that every now and then there does come this cull when providers just get lopped off and it's time for you to try and re-nurture that relationship or go looking elsewhere?
I think there's different ways of looking at this, and I'm trying not to sort of just look at it as a standard bulge bracket view. As a bulge bracket, there's going to be different variations in terms of when you are building product specialism and liquidity provision, and areas where you might be slightly weaker because you cannot do everything. and be amazing at everything. It's just you can't. It's the environment, the capital requirements around that is just impossible. So there are points in time where, you know, as a bulge bracket, you might not be on the list, or you might not necessarily be there. And it's also about having a frank and open discussion with your clients to say, yep, we're not there at the moment. This is where our focus is. This is how we can help you. This is how we can structure our arrangement. I think, you know, when you get out of the top 7, you know, bulge bracket firms, and correct me if I'm wrong here, but that's where you start to see a more difficult conversation, because, you know, you're going to link a lot of your flow towards those top 7, and then when you're in that awkward bucket, what are you actually doing? So that there's kind of a bit of a push there in terms of that rankings and where that evolves.
Yeah, it's kind of an awkward position, that kind of mid tier, because you are competing with the top tier. You're using balance sheet, but then there is a cost to that. So, and then the lower tier would be an agency model where there's no risk involved. So the kind of mid tier guys, I think, really need to specialize and not try to do everything like the top tier guys might do.
Let's come on to the relationship nurturing part of that in a moment. Owen, you can't manage something until you measure it. How are you measuring, quantifying counterparty relationships and making sure that you've got consistency across those metrics, particularly when you're working across developed and the emerging markets that you've got more than a few toes in?
Yeah, I mean, the most important statistic would be just volume of trading we're doing. And that's certainly what the banks are most interested in. We have a biannual review process where we go through all the asset classes for the tier 1 banks. And within each asset class, then we'll drill down into where are you seeing flow, where are you not seeing flow versus your peers. So we do provide quite detailed information, and we're happy to do that. You know, it's a mutually beneficial relationship. There is, I think, from my point of view, the soft skills from the salesperson is important as well. I mean, there's a lot of noise in the market, you know, with Bloomberg IB, emails. It's very difficult sometimes to filter that into usable information. So we rely on our sales to then provide us, you know, relevant color and access on bonds that they know we're involved in. And also to, in essence, work for us as a client as much as they do for their own desks, because they have we're stakeholders in that process as well. So we need them to be able to push their traders to, you know, give us the pricing we need to maintain those volumes.
Matt, when we spoke in the summer on this at the CMX event, you weren't on this panel, but something we did touch briefly on in that session was about dealer reviews. Owen, you shared some thoughts on that. But Matt, I'm keen to understand, you know, from your side of the dealer reviews, when they don't work, when maybe they don't feel as though they're as constructive as they might be, when there's more value that could be got from them, if only this thing were to happen, what would this thing be for you?
I think having sat on quite a few dealer reviews in my time across a number of asset classes, I think the key thing is actually interaction. You can have some information-rich dealer reviews. I think critically, and going to one of Owen's points, information about what your trading flows are, but critically, not just about trading notional, but trading risk. And really, from a client's perspective, being able to go, what have we done in risk? What have you done? Not without trying to give out any sort of secret source or any proprietary information, but to really understand what's happening. Because when you look at how people are building their metrics at the moment, it's generally off all the platform information. Now, if we take a look at sort of like OTC derivatives as an example, one thing that you could find on platform where you could say you're doing such a high notional of volume is actually compression trades, which are coming through and being put through from the buy side. Now, these are technically riskless. All they're doing is trying to optimize the portfolio and to be able to manage that accordingly. And there's no risk going through in the market, but they have exceptionally high notional value. Now, to me, that's a way of sort of spoofing your stats, because I'm not really doing any risk. I'm doing a trade that's not really that much value to you or the market, but aren't I looking amazing in the market share stats? And critically to me, I think there's information like that which should be stripped out. It's not relevant, right? Because as we said all along, it's about that partnership, that relevance in what's happening. I think also the other thing is the sell side. When you have these dealer reviews, you go into the room and you have your notepad open and you're scribbling down all the feedback. I think also there needs to be a feedback and engagement with the buy sides, because it's a partnership. And sometimes it's having some of those awkward conversations, and also having the right data. So some of the data I think we see in the industry at the moment is really, really high level, sometimes obsolete, sometimes out of date, quite a lot of the time. And so I think where we are in market structure, we should have a more detailed review. We should be looking at e-trading, non-e-trading, OTC. Everyone's looking at e-trading stats, but actually we should look at OTC risk and what's being done there. That's where everyone wants to be able to win the trades as well. And we should also be looking at statistics around, okay, what percentage of my flow am I doing through automated means? What percentages am I actually leveraging different providers, and where does this come? Because if we have that data in the right way, we can also have a good market structure debate to look at what's going to evolve in the right way for the end investor.
All seems to be very, very sensible there. Partnerships, having the right data to hand, making sure it's a two-way conversation rather than just a one-way street. Owen, anything to add to that to make sure that the dealer reviews are as constructive, valuable as possible?
I would just add that if an issue is coming up in a dealer review, it's probably too late. You need to be having those conversations, as they happen, and that's something that we strive to do for our important relationships. So we essentially want to nip any issues in the bud before they become, a block to trading and providing liquidity. So it's really about maintaining the relationship on an ongoing basis rather than waiting to a review to raise issues.
100% agree. And it's like those day-to-day issues, they should be dealt with. And if you've got a good sales guys, they're on with it. They're trying to deal with it and actually sort that out. And I think the dealer review is a lot more thematic in terms of the relationship and how you're progressing and how it needs to evolve, with qualitative feedback, I think, on both sides. To your point, David, I think it sounds really sensible and to look at the data, but a lot of people are just trying to base their information off electronic trading information data and not including OTC information in it, because that's not what I've got to hand, and I haven't got that data in a nice, easy, formatted way. And if we look at it, and as we've discussed already, all the OTC, all the big risk trades, they're done OTC. And these are the ones that we need to be focusing on. So my personal view, and with my FIX hat on, we need to be getting those OTC data standards up to scratch.
Just continuing on the line of the relationships, then, Owen, like friendship groups, they say you have friends for a season, friends for a reason, and friends for life. Is that similar in your relationships with counterparties as too? You've got particular counterparties whose relationships you nurture for the good times and those maybe for the bad times?
Yeah, absolutely. And there's some relationships that, if you look at it from a company point of view, they're much more important than just the trading volumes. So say if we see a tier one bank, slip a bit in our rankings, I think we're both incentivized to try to get those numbers back up to where they should be, because there's more than just that relationship, the trading relationship at stake. So to answer your question, yes, we do try to nurture the relationship as much as we can.
And Matt, from your side, obviously on the in times past and so on, being on the receiving end of those relationships, you understand where you are maybe in terms of that life, or just for this particular moment in their journey? You
do. I mean, I think there's the key thing in terms of, you have as a bulge bracket sell side firm, you have so many different types of counterparties. Particularly just look at the difference between real money and hedge funds. And you can look at how the profitability of that business can really change and adjust. Understanding where you are specifically with that business and understanding what you've got, I think there's a real gap there in terms of the quality of information, as I said previously. And I think that could improve. I think the receiving end, yes, things are cyclical. Yes, you go through, in terms of all banks, go through good times or times when you have innovation and evolution and you're rebuilding a platform. and bringing in, say, for example, a new electronic platform in a particular asset class, you might go through a dip. But the key thing is continuing to have that relationship, continuing to have that conversation, trying to provide value add away from that, such as market structure content, maybe. But there's a lot of different things that need to come in, and I think it's conversation, David, which keeps things flowing.
Yeah, just to add to that, I would say, trader turnover on the sell side is probably a bit of a risk on some of these desks. So it does happen sometimes more often than not, but I think to kind of manage that, you just kind of need to be open about what's happening, as in from a bank's point of view with your clients, how we're going to maintain liquidity, who's stepping into that seat, and just try to be as open and honest about it as you can.
And the same thing happens on the buy side as well. So, there is asset inflows and outflows, and there's people go through different times, but it is a relationship environment. And personally, I've always strongly believed that the industry is a family in a sense. And, if you behave in the right way and continue to communicate and work with people, the family's there for you and they'll work through it. But critically, behavior and engagement is important to that, to make sure you establish that relationship and maintain it.
Oh, the family thing. I like that. Let's talk about the problem middle child in that case. What incentives, Eoghan, do you provide to the middle children, the mid-sized players, to encourage them to, offer you flow when they might not be your favourite child, not necessarily part of your top 5 in your panel? Yeah,
I mean, it can be a tricky position to be in because we tend to stick to top tier in our large risk transfer type trades. There's a few reasons for that. Probably the most important one being we want to be relevant to them, and we want to have leverage over them in our relationship. So we don't want to spread our dealer wallet too thin. So it can be tricky to break into that. What I usually say is, highlight to us if you're doing a significant amount of flow in any particular market, because that definitely is a reason for us to trade with you, because we want who we trade with to be in the flow, so to speak. So we want them to have an outlet to recycle our risk. So that's very important. And the other thing we would look at would be our eTrading stats. So we like if we see them winning a significant amount of volume there, that's also a reason for us to go to them on the larger tickets, which is really the ones that they want to see, because that's what they essentially make money on.
I think this is the interesting thing as well, right? Because it's not a closed family. I want to be really clear in that, because it's not a closed family, because you can see what the likes of the proprietary trading firms, as we discussed at the beginning of this podcast, are growing in market share. And some of these guys are quite regularly in the top 5 as counterparties in terms of volumes with people across the street. And so it's not closed, and it's not just completely shut off to the banks, by the banks. This is open, and I think it is really, really important. I think there's going to be an interesting point to the point you just made, Eoghan, around e-stats, because if you look at these prop firms and you look at the amount that they're growing, the amount that they're doing on venue, if you then look at all your e-stats, do you then have a fragmentation of the market in terms of, I need the banks for the big risk, I'm now starting to fragment my electronic flow? Do we start to have a fracture in that relationship of, if you do well on my E, I'll let you see my big stuff? And I think this is where it's this is where I think it could be quite challenging.
Yeah, that's true. I mean, I think you could probably split e-trading into 2 buckets. The kind of liquid stuff that you're not, the trades you're not concerned at all about liquidity. So the way we would approach that would be, we automate as much of that as we can. And I think the approach on the sell side is the same. And then I guess you have the mid-sized tickets, which could be done on platform, could be done voice, in which case you don't want to blast those to the market. You want to tailor who you're sending it to. And that may be the mid players may not be on that list. So they want to be seeing that flow either by platform or by voice. And if I'm, say, unsure about who's best or who should be included in that market, that's a good measure for me to see who should be there, who's winning those type of trades.
I completely agree. And I think when you start to look at that, that's when you start having a hybrid workflow model. It's about understanding those flows, putting them together as a wider view and having that visibility. It's not just about trying to think about no touch and high touch. It's that this is all flows work together, and the central dealing desk from the buy side really providing value to the asset manager as a whole.
Yeah, because I personally want to be freed up to add value on those kind of trades. I don't want to spend all my time just clicking buttons on platforms, because it's really not the best use of my time.
So, I mean, we've led very well in that case onto eTrading, and you've already touched on it there about the types of trades and how the engagement between buy and sell sides has changed depending upon whether it's the smaller trades, mid or the large. Is there anything that we need to watch out for in this evolution of how we trade with regards to the relationships, though? Because you are having less contact points than you might once have done, Owen. I mean, you've seen a lot of changes in your time, the same as you have, Matt. So are there any things that we need to be conscious of, to watch out for, to make sure that along with the benefits, along with the additional value that these platforms provide, we don't suddenly find out that we've lost something else that's valuable, that's important too? From
my point of view, you're right, and it does take away some interaction with the banks in terms of, because these tickets, and in terms of the actual number of trades you do, they're obviously very large. It's most of the trades we do, but in terms of volume, it's quite low, because our larger tickets would be much bigger. So there is a risk to the relationship in some regard there, that you're not speaking to your counterparties as much as maybe you would have before the trading platforms were as proliferate as they are. However, there's really no other way to do it. With the amount of flow that's going through the market now, it's the only option. I think it's only going to increase. So there is a challenge there. Probably best addressed by sell-side salespeople, just to keep in contact, keep the relationship open, and I don't see it causing too much of an issue.
When you look at this, I think I was talking to my son as he was going to his new school this week, and he said, it's like, it's human nature to push back against change, because change is, you don't know about it, you don't know how this is evolving, and it could create problems. And when you look at this, that is the initial reaction, David. That's, when you look at a number of the panels that have been asked, that's the initial question. But fundamentally, if we go through the debate we've just had, and you go back to the point of what are the sell side doing? The sell side for Owen are when we're coming in and stepping up and taking that risk when he really needs it, and to be able to manage that accordingly, which are the trades that the sell side want to win. So that means you've got to have voice sales. Voice sales in no shape or form is ever dead, because that is the relationship. You can't just leave the risk models to run massive high risk trades with an AI engine behind it. It's not going to work. The critical point to that then is actually, I think this creates diversity. You still have the voice salesperson, you still have that person generating the acts, being the advocate internally for the client as well. But then also you have e-sales people now coming through. You have market structure people coming in, providing that value add, providing that engagement, maybe providing that color that might not have seen before, maybe agitating the conversation around the question of, is the axe quality you're seeing the right thing? Because now you're getting a lot of electronic axes. And is electronic the right term to use in fixed income? Because when you look at fixed income electronic trading, that means we need on venue. Well, to me, that's nonsense. Electronic is everything, right? Everything's touched by an electronic trade. So we should look at revitalizing that term and moving on. So I think there's more opportunities, more touch points, but maybe more rationalization of the traditional engagement that you see.
There's a lot to break apart purely on the electronic trading piece there. I'm not sure we're going to have time to take that apart and to fish in that pond any more today, because we are out of time. But listen, Matt, Owen, thank you so much for chatting us through that and helping us to understand the relationships, helping us to understand really how to get the most value in these relationships right now as things are changing. Thank you both very much indeed.
Thank you very much for having me.
Thanks for having me as well.
And a reminder that you can catch up with our previous episodes here on CMXtra on topics such as AI in trading, T+1, that's been and gone. Now, leadership and culture. You can find those and more wherever you found this episode on the cmx.com. That's the-cmx.com. cmxtra.com, and of course all the normal places where you'll find your podcasts. If you like what you heard today, then share it with your colleagues, leave us some feedback. The CMX page on LinkedIn is a great place for that. And well, while you're there, perhaps tell us what you'd like us to cover in the future. And speaking of the future, at the top of the show, I promised some intel on the next in-person CMX event, and we can reveal that, well, CMX will be back at the Woolwich Works in London once again, this time on Thursday, July the 3rd, 2025. So put the date in your diary, get practicing on the Scale X trick and the giant Jenga, and trust me, July will be here before you know it. But that's all for now from me, David, and from all the CMX production team. Thanks for joining us, and until next time, bye-bye.